A very good morning for all of you. I am Priya Karthik. I'll be moderating this meeting today, and many of you would be aware of the activities of ATEA, that American Tamil Entrepreneurs Association. Just want to give a brief intro. It is a non-profit organization that provides an excellent platform for aspiring, budding, and successful Tamil entrepreneurs to connect, educate, and share ideas to bring their entrepreneurial dreams to reality. All of us have our great entrepreneurial dreams, and an organization like this is going to make your dream a real come true. And this is one place where we can connect with founders, mentors, investors, and whoever is going to help us make our dreams come true. And share, they're here to share their innovative ideas and strategies. So this ATEA webinar series was initiated with a goal to make this connection possible for all people across the globe. And ATEA will be organizing one webinar a month. And today's webinar topic is designing capital instruments for startup that works with angels, employees, and VCs. This is one major topic that as entrepreneurs we really need to learn. And the basic outline for the webinar today would be any successful startup needs to raise capital from its infancy to its journey as a unicorn. A good understanding of various types of capital instruments like equity, preferred stock, common stock, debt, convertible note, etc., and the futures and options like equity warrants, stock options is a fundamental requirement for succeeding for all startup founders. All these technical jargons might throw people out or might be scary, and I think we have a wonderful speaker today who is going to not scare us but help us understand the intricacies of all these things. And I'm glad to welcome our speaker today, Venkat Radhakrishnan. He is US-based investment banker, management consultant, and finance executive with over 25 years of experience in banking, financial services, insurance, life sciences, and technology sectors with an international consulting background. Who else could be a better person to speak today and educate us with all the core requirements of making our dream come true? Venkat is currently a partner with Spectrum Capital Advisors, a New York-based investment bank focused on raising capital through private placement of securities with institutional investors, and also offer M&A advisory services. I think he would be of great help, and even after the meeting, if you want to have some connection with him, you can reach out and he'll be able to help you out. And he's a chartered accountant and a cost and management accountant from India, and he's also a registered investment banker. So I welcome Venkat Radhakrishnan today to share his ideas, knowledge, so that we can learn a lot from you today. Venkat, welcome.
Thank you, Priya.
Yeah. Before we start off, we have some basic house rules. I just want all the participants to stay muted so that there is no disturbance or there's any kind of hitch in between. You can mute yourself, or the moderator or the host can mute for all of you. And there'll be a separate question-answer session at the end. So if you have any questions, keep it. You can either type it on the chat window, or you can wait. At the end, we'll be unmuting you all, and you'll be able to ask your questions at the end. Of course, this whole webinar is recorded, so it will be available in the future also. So we are all set to start, and I welcome Venkat to start over.
Thank you very much, Priya. Good morning, folks. This is Venkat. I just wanted to set some initial expectation for this presentation. Before I start, thank you very much to ATEA and the members, on a Sunday morning, if you come up, it shows your passion and energy. So thank you so much. So, in terms of broader focus, I wanted to stay focused on young startups, which are, just starting to roughly 3 years old, right? Those who have crossed 3 years and they're into high growth stage, probably, their expectation, their playground is different. So that also will not cover growth stage or unicorn startups because, they would be working with institutional investors and this presentation will not help them. I also wanted to tell you that I'm not an American CPA or a tax attorney or a startup funding specialist. So what I'm sharing here is more, the stage where we generally come in and help is where the company has raised its seed round and also probably a Series A, $3 or $5 million, and then they're looking to raise Series B is when we get involved. So some of my knowledge I bring is more looking at it from that perspective. Another disclosure I wanted to make here is I'm also a founder of a fintech company. I'm in the process of raising money. I just wanted to put it out there for the consumption of our audience, elite audience here. Again, if you are a Wall Street banker or a Wall Street investor or you are a finance guru from Wharton, probably, I'm not targeting you. I'm targeting, entrepreneurs who are either starting or in the process of scaling up their companies. Finally, we will not cover initial public offerings. We will not cover publicly listed stocks and or other complex financial instruments, right? With that preface, if we look at what are the critical success factors for startup, so if you look at the situation today, unlike 5 or 10 years back where you need a couple of $1 million funds to be raised before you bring your minimum viable product. Today, because of cloud, because of emergence of technology, because of the faster to market that a product can be brought at a very low cost, all that you need is a good idea, a good architect or a technocrat, and a good founder to bring all this together. It's that easy today. But still, over 90% of startups fail in the first year. Hardly, I think, lower single-digit percentage make it to 3 or 5 years. So when people like Harvard Business School or others have looked at what are the top 5 critical factors, founders, your strategy, your product, attitude, these are all absolutely essential. And also, your funding strategy is also going to be very critical. If you don't bring the right kind of investors or lenders to your company, to your startup company, it can become, instead of a successful factor, it can become a factor that can affect your growth. So that said, I just wanted to, just to give you an outline, what I thought we will do is we will look at the common funding types, then look at who are the investors, what are their expectations as a second area we will look at. Third is we will look at the capital instruments. Finally, I wanted to pull up a cap table and kind of give you it's a generic template, but it has got some dummy numbers in that. With that, I'll give you an idea of how, a journey starts from seed to Series A. I will walk you through that particular template just so that you get an idea, right? So when you look at for any startup, the most common funding sources are, first is bootstrapping, right? The founder and his team, his co-founders, they pool their savings or their resources, develop a minimum viable product because they had this idea at their workplace or at their consulting place. So when they bring the minimum viable product, they take it to a known customer, and the customer is willing to finance that proof of concept or build out. So on the client's money or on the savings and investment from the founders, a product is built and you bring it to market and the startup is on. So there is no dilution. 100% of the equity belongs to the founder and his team. The second type of funding is equity funding, and today we will spend a lot more time, starting from a seed round. Now people call pre-seed round. These are all jargons, right? Some are flavor of the times that we live and work with. From seed, you go to Series A, then we go to Series B. In every successive stage, there would be dilution happening. Depending on the money that's being invested, anything from 1 to 100% equity gets diluted. Finally, we also have debt funding available. It's not always necessary that you have to, as a founder, you have to dilute your equity and raise money. Sometimes, you can raise money from, friends as loan. There are n number of stories where very successful founders have funded their initial investments through credit card debts, right? There are people in Shark Tank or other forums you would have come across. There is venture debt, meaning, there may be angels or family offices or VCs who will be interested in lending to you as a venture debt. If the startup that you have is a very thriving revenue generating business and it has got, assets like working capital or a receivable or inventory, the banks may come in and give you line of credit. Then there are asset-based loans. SBA loans, you may be surprised to know that there are hedge funds which are interested in financing litigation, right? If a law firm sues somebody for recovery, there are people who are willing to lend. These are all different types of funding sources that are available. And the meaning of dilution is that when you issue equity in your company to an investor, you are giving away a portion of your equity, and also you are giving away a portion of control of your company and also profit sharing. That's the kind of impact of that. Now let's now look at who are the equity investors and what are their expectations. So in this particular slide and next slide, I'm going to talk about 7 or 8 types of equity investors, right? So the first very immediate equity investor that comes in contact with the startup is friends and family. Typically, the investment coming from them is $10,000 to $50,000. In the life of a startup, that would be the first source of capital, because it's easy to go to your friends and family, ask them for money. Their expectation is usually capital appreciation. I have added financial returns because sometimes, if you go and speak with or talk to investors who are elderly and, they are investing from their retirement funds, they would look for annuity returns, right? Like, for example, they would say, I'm not so keen on equity in your company, common stock in your company, but can you give me like a bond or a note and give me 8% interest, instead of me keeping in the bank, I will invest with you because you are my, known to me. So the instruments typically are, used in this particular, with this particular equity investors is common stock we will issue, or we will go for convertible note. What are these instruments? What are their features? We will cover them in a couple of slides down the line. So this is friends and family, right? Next is angel investors. So angel investors are usually, investors who are very professional investors. These are kind of individuals actually, right? They are not necessarily an institutional investor. The difference between an institutional investor and an angel investor is an institutional investor has a large pool of capital that he wants to raise. They have very structured investment process. When you work with them, they have a very definitive application process, a review and investment process. In the case of angel investors, they have also become much more organized, much more process driven. You would see groups of angels in every state or in every major city these days. And there are also angel investors by industry, for example, biotech or technology. There is this tie which is very popular. So typically these angel investors invest anything from $25,000 to $100,000. And the size of money that you can look to raise with this group of investors is between $200,000 or $250,000 to $1 million. Sometimes, you can also raise $100,000 from angel investors. That's also possible, right? The number one objective the angel investors will have would be to see capital appreciation. They are open to common stock. Most of the angel investors prefer common stock because, let's admit that they want to be, the guy who wrote the first multi-million dollar check for Google, he ultimately has become a billionaire, right? The Sriram, right? So they would like to be enjoying the appreciation of your company, capital appreciation of your company. Next, we have accelerators and incubators. These are, a place where they provide not just a place to work, but they provide guidance. They bring investors. Some of the accelerators today are highly organized. For example, there are fintech accelerators which can bring, bankers or other people to you. So typically they invest $100,000 or $150,000 in return for standard. Sometimes they ask for, I think, 6% equity in your company, taking a standard valuation. Along with angel investors, you can approach accelerators, but most of the times what I have seen working with accelerators is that when you've completed your friends and family and you've got one or two angel investors, that is the time you should go to an accelerator, because an accelerator will ask you, have you got any external capital? And if you say only all friends and family, unless you've got a very powerful product, somebody like a Citibank as your customer, accelerators generally reject a lot of applications. So if you have an external angel investor and then go to accelerator, your chances of getting accepted, getting money from them becomes high. Their expectation is again capital appreciation, and sometimes they also want to rent out their space, right? They have such key real estate in major towns or in a university that they would like to fill it up and make it available to everybody. Then we have venture capital funds. Venture capital funds typically come in when you are raising an institutional round. They invest anything from $500,000 to $5 million. $500,000 mostly coming from early stage VCs, as we call, or sometimes there are family offices who could also come in and invest. You will also hear people like independent sponsors. Now I see them a lot. These independent sponsors are people who are either earlier serial entrepreneurs. Now they have set up a investment fund, and what they do is they have relationship, they have clients and all that. When they see a very bright entrepreneur or a very bright product or a solution, they write an initial check and then they become an independent sponsor supporting you through the process. So venture capital or institutional round, typically, you raise between $3 to $10 million. Finally, in terms of sequence, they would be the third in your cycle or third in your round. 100% of the time they look for capital appreciation. And the two types of instruments they like, one is common stock, second is preferred stock. The next set of equity investors are people who don't necessarily invest money in your company or capital in your company as cash, but rather they offer a service, and in return for the service you share equity or a portion of your company's appreciation, right? So first is I would look at employees. And why would they accept, part of your company? Because, they want to be part of the growth story. They want to, because you're in the beginning of entrepreneur's journey, we are resource challenged, right? So we would like to offer them a portion of our company. And usually we end up offering them equity warrants or we can give them stock options. Sometimes you bring an extremely bright and very resourceful executive into your company. You might offer them common stock. Like, for example, some of the new generation fintech companies, when they bring, for example, a CFO or a global partner of Goldman Sachs into their company as a key executive, you must offer them common stock. You can't just tell him I will give you warrants, right? Because he can bring big business on the table. Your valuation will suddenly go up because of his heritage and background. So how to determine valuation for these guys? Typically, it will be a very subjective conversation. I think towards the end I will answer this. Then we have advisory board members, right? Advisory board members are very important. Once you have built a product which is a MVP product and you're taking it to customers, the first set of customers are going to look for credibility. And most of the times your advisory board members will be able to open the door. They can review your product, offer very concrete suggestions. So advisory board, my suggestion is that you keep it to 2 to 3, not more than that, because managing them becomes very difficult. And when these guys come in, at the time they sign up and join you with the paperwork, you need to give them a portion of your equity or stock options or warrants, right? Because he's committing to helping you. Then for every year of completed service, you could look at giving them 0.25% or 0.5%, depending on what's the value of your company and what's the contribution from this board member to you. That's another set of investor who would come in. Then, of course, an entrepreneur or a startup entrepreneur should also be open to bringing consultants and service providers. Often you don't need to have money in your bank to hire them, right? There are some very high-end law firms which are willing to work with you, provided you have a product that is market ready or market acceptance. And so these service providers or professional advisors like a law firm, they may all accept a portion of your equity. So for these guys, again, you can offer them equity warrants or stock options or common stock. So I think this should probably give you an idea of who are the equity investors and what are their expectations. Now, I'm just going to do a conversation on the different instruments. What I did was to just take the definition of these instruments from a standard site like Investopedia, because, if tomorrow you are trying to refer this, you must be able to understand this language and speak this language with your investors. It's only for that reason I brought it up, right? So common stock, that is the primary instrument that conveys ownership in a corporation, right? So, for example, if you would like to go the route of growing your company to 100 million or a unicorn, $1 billion company, my suggestion would be look at incorporating the company in Delaware as a C corporation right from your start. The reason I say is many times even I made this mistake of forming a corporation in the state of New Jersey. But when I go to a VC, for example, the VC would always prefer me to do it in Delaware because of the tax advantages and the other advantages available. So in a C corporation, for-profit corporation, the common stock provides ownership to founders and anybody else that are owning stock in the company. And of course, a common stockholder elects a board of directors. You are entitled to vote on key matters of the company. Then you are, when the company appreciates and the company is able to declare dividends, you will get dividend. Liquidation is in case the company is not able to, go beyond a certain number of years and it goes into liquidation. Common shareholders don't get anything. You're in the last in the hierarchy to get money. So, but in terms of control of the company and the benefits you will enjoy from ownership, common stock is the number one instrument that you should look at. You should dilute your common stock only if no other instrument or no other type of instrument is available. Okay. The second instrument is preferred stock. In the case of preferred stock, it is also a class of ownership. The difference between a preferred stock and a common stock is, in the case of preferred stock, they don't have voting rights. For example, a preferred stock owner cannot elect board of directors, right? Unless you're, everything that I say today is subject to an attorney can always institute a class saying preferred stockholders can nominate a director on the board, in which case they can do. But the general understanding is a preferred stockholder cannot nominate a director on the board. They receive dividend, and the priority would be that when there are profits in the company, if there are preferred stocks in the company that the company has issued, then you have to pay dividend to your preferred stockholders first. Sometimes if the type of the preferred instrument is a cumulative instrument, then whatever arrears in the early years that you have not paid, you have to pay all of that, and then you will pay dividend to your equity shareholders, common stockholders. Okay. So preferred stock at a very high level kind of combines debt. In that you have to pay, dividends. Sometimes, a preferred stock, we would say 6% preferred stock, which means, if somebody has contributed $100,000 of preferred stock, annually you are agreeing to pay $6,000 as dividend to him, right? That's a fixed dividend. When it comes to liquidating the company and, sharing the assets of the company in liquidation, preferred shareholders get priority after the lien holders and bond holders. Okay. Just moving on to convertible note. Convertible note, I wanted to spend a couple of minutes because this is one of the most preferred form of instrument that's issued by a startup. So in the case of a convertible note, it is a hybrid instrument, right? If a convertible note is a 24 months, 6% coupon carrying convertible note. For a period of 24 months, the convertible note is a debt instrument. When I say debt instrument, you don't issue common stocks at that point in time for the first 24 months. And you agree to pay them every year 6% return on their investment. So the way this will work is, for example, I would ask you to look at the example I have given here, which is a convertible note issued with the valuation cap of $4 million at a 20% discount. This is like a term of a convertible note. So in this scenario, when the investor comes in and subscribes to your convertible note, at that point in time, you tell him that you would limit the valuation or make available valuation of your company in the next round of capital at $4 million. And because he is an early investor taking the risk along with you as a founder, you are willing to give him a 20% discount in the next round of capital raise. Assuming in 2 years, when you go to the next round of capital raise, your company has become, much more attractive. You've got clients, you've got revenue coming in. There is buzz in the market that your product is an outstanding product. Instead of $4 million valuation, your valuation goes up to $12 million. Now you cannot tell the convertible note holder, look, in the 2 years, my valuation of the company has gone to $12 million. So 20% discount will be on $12 million. You cannot say that. Because at year 0 when he invested, or the time 0 when he invested the convertible note, he took the risk, right? So at the next round of capital raise, what we do is we take whatever is the valuation or 4 million, whichever is less. So 4 million is the lower valuation. In that 20% discount you will give. So a $10 price share. When you issue in your next round of fundraising, you will issue to him at $3.33 instead of $8 to him. Okay. So convertible note is the most comfortable instrument that early stage investors prefer. Because valuation is not a question at that point in time. So this is an instrument that I would suggest you're becoming more comfortable so that you can use this to raise capital. Just moving on, stock options, right? So stock option is like a benefit you give to an employee or an advisor, a board advisor, to buy stock in your company at a discount or at a fixed price. So what you have to remember here is it's an option. Okay. So when I say it's an option, the employee or a board advisor who gets this stock option, he has a choice. He has a freedom to either to choose the option, subscribe to your equity at the discounted price or at a predetermined strike price, or he can choose not to subscribe. Okay. So here it is an option given to them. And for example, if I'm an early employee of a company like Uber, and Uber had issued to me a stock option that enables me to subscribe at a predetermined price of let us say $5, and that option vests with me in 24 months. And in 24 months, let us say the valuation has multiplied 100 times. Then definitely I will subscribe to such options. Okay. What is this vesting? Vesting is, a certain minimum number of period that you have to hold that option, or you have to service that option, and then you can exercise this option to subscribe. Okay. So there is a example I have given here. Not to get too complicated. If an option is available from, I think I saw some proposal from a Silicon Valley group. They have approached SEC to set up a trading option for the Silicon Valley companies, especially startup companies. They don't want the founders to consider going and listing and enabling an exit option for their initial employee stock options or warrants. Instead, they're talking about creating a public listing exchange, where a startup company's options can be listed and traded. It's just still in the works. So an option to an employee or a board advisor gives them an entitlement to get a portion of the equity of the company, provided they either stay with the company for 2 years or 18 months or 36 months. Typically you write between a year to 3 years, not more than that, right? Just moving on, stock warrants, right? Equity warrants. An equity warrant will enable a holder to buy the underlying stock at a certain exercise price, right? So the difference between here, the equity warrant and stock option is, in the case of option, as the name suggests, it's an option available to the holder to buy the underlying stock. In the case of equity warrant, it's an entitlement. You have to necessarily buy it. If you don't buy, your warrant loses its value. Okay. Now, typically, the way you will see warrants are issued is, most of the times stock options are the most preferred non-cash capital instrument you will use to issue to your employees and to your board advisors. Equity warrants are mostly used when you bring early stage VC or a family office who write a big check, and he says, I'm coming in, I'm taking the biggest risk by investing $500,000 or $1 million in your company at the early stage in your career, in your growth. That I need a sweetener, right? A rear-end warrant, equity warrant. So you give them that equity warrant more as a sweetener that he will subscribe today your bonds or convertible note. Okay. And of course, as you see, warrants are detachable. They can be sold independently of the bond or stocks. But whether can they be sold or not, you can always, stipulate this in the agreement, subscription agreement that you have with such investors. Again, it's all a question of negotiation between the investor and the founders. Finally, I wanted to touch on this enterprise valuation because this is often critical topic that comes up. In very simple terms, enterprise valuation is a market value a buyer will pay to buy your company, to buy your business. Looking at it alternatively, if a company has got multiple owners and stakeholders, like common stockholders or shareholders, both preferred and common stocks, and also creditors, right? There may be bondholders, or there may be lien holders, or venture VC debt holders, right? All these claims, if you add up everything, then that is the total value of your company, right? Now, valuation of the company is kind of critical to determine the percentage of equity an investor will get in return for his investment. Now, without again complicating this discussion, valuation will become critical when you speak to any type of investor. When you talk to institutional investors, you need to have your financial model. A financial model is, what will be your 3 or 5 year P&L projections, your, balance sheet, a projected balance sheet, your cash flow, and then the underlying assumptions, business assumptions. Most of the times, we also add a discounted cash flow based valuation. All this, are important in a financial model. But in the initial stages of a company's fundraise, from either angels or a convertible seed round or a pre-seed round, you don't need to necessarily have a complicated financial model. If you have very simple revenue streams identified and cost, indicated and certain profitability estimated and shared with your investors, I think that should be fine. So valuation is again, a critical knowledge that you need to have. Valuation for a startup is very tricky, very subjective. Of course, most of you know this. There are various methods used for this analysis. Discounted cash flow is one of the popular methods. Of course, future performance. Always founders of company or entrepreneur who starts the company thinks very highly of the market potential, but the investor would not, take that number. So valuation is always a subjective conversation. One of the things that I didn't mention here is comparable transactions or comparable, industry numbers. That's another way to go. And to explain that, for example, you are starting a customer engagement digital transformation platform. If there are another company in the same space that has been funded, you can take that funding number as a starting point and negotiate with your investors. Or if a similar company like you with your platform with certain number of customers and revenue and all that has been sold, then you can use that as a benchmark to do valuation. So those are called comparable transactions, right? So that is all around the enterprise valuation. Finally, I think this is the last slide. Just to give a little bit more color to investor expectations, when you talk about capital appreciation, when the friends and family come, probably, you're looking at, let's say, a $500,000 valuation or $1 million valuation, because at that stage, it's only an idea. You've, let's say, created a very minimum viable product on PowerPoints or on, let's say, using an open source technology, which you have convinced your friends and family. Then when you go to, let's say, angel investors, you have been able to scale it up. At least one client has signed up with you. And now you tell the angel investors, my company is worth 2 million or 4 million or 3 million, whatever that number is, right? So if you look at it from your friends and family, when they hear that the valuation has gone up to $2 million, they feel comfortable that their investment has doubled, right? And when from angel, when you go into, let's say, a Series A for 5 million raise or a $10 million raise, assuming you have got some great names as your customers and you have established a SaaS model, subscription model, you are already, covered by multiple business magazines and you are very popular. You are in some key markets, either in Europe or America, North America. then your valuation may be, let's say, $25 million, right? So you as a founder of a company or as a co-founder of a company, you need to clearly have this mapping in your mind where you would like your company's value to go. Now, the numbers may be, just a set of numbers, but you need to have a baseline number. Now, can you throw the number to investors? I would suggest don't do that. You need to have a certain rational basis why you throw certain numbers, right? Often, valuation is a topic that you don't want to bring upfront with an investor. You have to always talk about the value that you will deliver, the qualitative factors that will help your company valuation, rather than a fixed number as a valuation. Because often I find either professional investors coming from institutions like VCs or family office, or even very accomplished, seasoned angel investors, they don't want you to talk about a valuation number upfront. Though they will ask you, just to tease you, what is your pre-money valuation? Let's not jump in and say my pre-money valuation is $4 million. Instead, you can say, companies in this space, I see them getting X number as a valuation. My product is at this stage, and I think because I'm bringing, machine learning, or I'm bringing this niche, business problem I'm solving, my company could be worth much more, or I think the company is much more worth, and I would like to hear your number. So, at the end of the day, an investor comes in mainly looking for capital appreciation. So you cannot, just raise money and endlessly spend it on technology development. So most of the companies which are a big failure, right? They have raised 50 million or 100 million and then they failed, are guys who have not recognized financial discipline. When there is no financial discipline, you will end up spending on the product development or on market development, or sometimes on holiday parties, ultimately to look back that the investors will feel cheated that you have not delivered, right? So number one expectation is capital appreciation. Second is financial return. I think we saw that. So these are the two, expectations. Now, what I'll do is, I think we need to give another 10 minutes time for question and answer. What I'll do is I'll just take a couple of minutes to walk you through a Excel spreadsheet, which I call as a cap table. And I'll spend a couple of minutes on that just to give you an idea. And then I think, Priya, we can open it up for questions, right?
Yeah, sure.
Yeah, so this is a template we call capitalization table. It kind of shows you a journey of a startup from pre-seed or pre-investment round till, and then there is a convertible note being raised. There is a Series A being raised. Series B, I don't want to touch because it's a completely different conversation, right? Young startups, they don't get there that quick. So in a pre-investment cap table, all of you are able to see my Excel spreadsheet, right? I'm assuming yes, right? Yeah, okay. So, instead of employee, you can also, take that as a founder, right? Let's say 3 co-founders. At the pre-seed stage, if you're forming a company, let us say a C corporation in Delaware, I would suggest look at, don't go beyond 10 million as a common stock, right? Because I think if you go beyond 10 million stocks or shares, then your franchise tax goes up based on the number of stocks in your company. Uber, we were seeing the other day, what is the initial set of equity? I think they are at 175 million stocks. They're okay, 70 or 100, I don't know what's the latest valuation they have. They are okay. So here, if we have 2 instruments, right? One is I have got a common stock, and then I have got common options. When you start your company, don't make the capital structure very complicated. Keep it simple so that it becomes easy to raise money. So in the starting of the company, if you keep 10 million as your common stock and you keep 7.5 million as your options, that ultimately goes up to 100% of your holding of your company. At this stage, let us say, the investors, before investors, the founders among themselves, they have got an agreement that they will divide the equity in the ratio of 40 to 24 and 11 between the three of them. Or let's say employee number 3 is your CTO, whom you brought on board. He's not a co-founder, but you want to bring him on board. And let's say you want to give him 10% equity. That's a possibility. Now, some of the other employees who are coming in, you issue options to them. So at the stage where you've issued options, your equity has not been diluted. You're only given the option to them to subscribe. Let's say at this stage you have raised $25,000, your own money, and the issue price, you can keep it at $0.0001 dollar, right? Or not even a cent, but 1/100th of a cent. So at that rate, when you subscribe 7.5 million stocks, you would, let's say, be paying about $7,500 to the company, and you will get 7.5 million stocks of the company. Why are you taking like that? Because at that stage, you are taking the biggest risk of your life, and you're starting the company. So at this stage, when you look at how the cap table will look like, let's say employees and the founders, they own 16.3 million equity and options, totally owning 93% of the company. Let's say advisory board members, they own 1.1% of your company. Typically, what I've seen, again, please don't quote me, but what I've seen people talking about a best practice or a leading practice is to offer 0.25% of your equity at the beginning to your advisor as a sign-up. And then for every completed year, standard 0.25%. But if they provide a lot of value, like, he introduces the first client, I have seen companies offering as much as 3 to 4% of equity. Because your first client, let's say he's there, JP Morgan, right? Your valuation will go from $1 million to $10 million when JP Morgan. And if that advisor has opened the door for you, you can give them 5% of your equity. There's nothing right or wrong about it. Okay. So at this stage, the employees, and one other thing I wanted to call out is you can keep a pool of about 1 million options as a pre-investment option pool. And this pool is more like a pool that you're keeping it on the table. In future, if you are employing any new employees you're bringing in the next 2 years, from this pool, employee pool, you can offer them options, right? As the value goes up, you can offer them lower options, but you can keep issuing them. Now, going to convertible note. So convertible note is, let's say after 6 months or after a year, you need, let's say, $500,000 money to come in or $1 million money to come in. You want to issue, let us say, for $1 million convertible note. At that point of time, when you issue the convertible note, let's say here the example here is we are offering 8% interest, 20% discount at a valuation cap of $4 million. So when people are investing, let's say there are 10 angel investors who are investing $250,000, $50,000 and all that for a total of $1.1 million. At this stage, you are not issuing stocks to your convertible note subscribers. He's more like a lien holder on your company. He's a lender to your company. He's a creditor, right? He's a lender to your company. So assuming this is a 24-month convertible note, until that period of 24 months, let's say you're issuing it on 1/1/2015 or let's say 2019, then whole of 19, whole of 22 calendar years, he's only a creditor on your books. On 1/1/2020, 19, 20, 21, 1st January 21, you will issue stocks to them. I hope you all understand from a timeline perspective, right? So until we issue stocks to them, there is no question of any dilution. So here, if you see the equity, the same position continues even in the convertible round. The difference being your equity is getting diluted as the 24 months starts running. Because, when you issue the convertible note to them, you're promising them that at the end of 2 years, for an angel investor who has subscribed a $250,000 convertible note, you are promising him that every year he will earn 8%. So at the end of 2 years, let us say he would have earned 16% interest on his $250,000. So whatever is that accumulated value, just for the sake of conversation, let's say it's $300,000. That's the value that you have to pay him at the end of 2 years. Now, you will take the capitalization at $4 million as the cap. On that, you would give him a 20% discount. And if he is entitled to stocks worth for $300,000, he will get 20% discount on it and he will get stocks. Okay. How will that look like, right? So let's go to Series A. So in Series A, for example, let's say we want to keep a pre-money valuation of $6 million, and let's say we want to raise new equity of $3 million. Totally, there is a convertible note that will get converted at 1.1 million equity. So at the stage of Series A here, so far the journey that you have taken is here in the pre-investment, the founders and advisors, employees, everybody, either through their entitlement or actual subscription, you have raised, let's say, $50,000. In the convertible note stage, we have raised $1.1 million. And then when we come to Series A, right, the next round of fundraising, let's say we are raising $3 million. At this stage, what happens is, into your equity, you are receiving totally $4.1 million. $1.1 million of convertible note gets converted to capital, and then there is a new equity of $3 million coming into your company. So there is a pre-money valuation of $6 million. There is $4.1 million is getting added. So your post-money capital is, let us say, 10.8. You would be wondering why 10.8. The subscription actually we have received is only 4.1. The difference of $700,000 is explained because of the discount that we gave to the convertible note holders. So how does this look like? So for the angel investors, they are subscribing all this equity. Now, if you look at the cap table, on a conversion basis, here is the conversion, how it's happening. Like, for example, angel, when with the principal and interest, he has to receive $273,000. On a 20% discount, on a cap of 400,000, let's say our issue price is in Series A 30 cents. Your 0.001 has now become 0.3 cents issue price, right? On that, we give him a 20% discount. So the conversion for a convertible note holder is 0.2. So the number of shares that will get issued to this guy is worth about 1.366 million. So the Series A, you can, as you can see, this is the stock that will get issued. So someone who had issued, who had subscribed $273,000 that he has to receive, his capital has gone up to 1.3 million worth of stocks. And for people who subscribed to your convertible note at the rate of $25,000 for a total of $382,000, to them you will issue $1.93 million, right? So ultimately, at the end of Series A, you have three class of shareholders who are taking a position in your company, right? So there is this first set of original founders of the company, and then the other employees who came in, and then the initial set of board advisors. This is the first set of founders of the company. Let us say all of them, if you look at the equity holding now, as at the end of Series A, the stocks have got diluted, right? From 37.5, it has come down to 20.8. But what you need to realize is this 20.8 is on a post Series A valuation of $10.8 million. So I think probably this must probably give you an idea of how this is getting structured. Then if you look at the two other claimant groups, right, the angel investors who did the convertible note, they would be receiving in the Series A stage 8.5%. And then, if there is a VC who is coming in and he is investing $202.5 million, he gets 52% of the company. Okay. I mean,
so I can see we have some questions here.
Sure, let's go with the questions. I'm sorry, I'm good, Priya. We can take questions.
Yeah, sure. It was really valuable. It was very good. I think even for non-finance background people, it was very explanatory. It was got a very good idea. So thank you very much. So I'll start off with the questioning because we are running out of time. I have a question from Ilango. What is the best way to verify my valuation is almost similar to an angel or a VC numbers?
Ilango, that's a very good question. The best way to validate your valuation would be to speak with an external investor. So if you are in the angel round and you want to validate whether your enterprise valuation is right or wrong, or whether it is in the ballpark, would be to reach out to a professional investor, angel investor. And to that professional investor, you can tell him very clear that, I'm validating my valuation numbers. Set up time with them, share your financial numbers or your valuation basis, and then ask them for their feedback. I think that is one way to validate your valuation numbers, Ilango. I don't know whether that helps.
Yeah. I hope he was able to answer, get your point, Ilango. Ilango also has another question. In seed round 1, what is the percentage of share VCs would expect? Is that decision comes from founders or VCs?
So, I would call out two different situations. One situation is, in general, when you are reaching out to an institutional investor, a VC or a early stage VC or a family office. Family offices are very active these days. I just wanted to, let you know. So these firms typically look for, taking a majority control in your firm. Usually, if you go to the website of early stage VC and look at their investment criteria, that will lay out. They will say, I am a majority, I'm a control investor, or they will say, I am open to minority recapitalization, or I am a growth stage investor. So you need to know what is the investment strategy of the early stage VC. If you're talking to a VC like, let's say, Bain Capital or a large VC, who always prefer majority control, then you need to be prepared to offer that. So it's often you need to know who the investors you're talking to, and then have a game so that you will win, right? An investor who always looks for a majority control, if you go and speak to them, tell them minority dilution is what you're doing, often you will lose, right? It's a waste of your time. So that's one situation. Second scenario is if you're a pretty strong company with strong technology, good client portfolio, then you can dictate what you want to do, right, in terms of dilution. You can say, I want to dilute only 20% of my company, 30% of my company. If you're interested, come in, right? And I also want you guys to think about strategic corporate investors, right? For example, tobacco company, American Tobacco or, Altria, they are going and investing in the vape company, right, Juul, right? They are doing it because they think it's an innovative technology. So again, it depends on, long story short, it depends on the strength of your company and what you want to do. Understand your investor and then discuss with them the options. We can move on, Priya.
Yeah. I think Salman has a question, but before that, Salman, do you want to type the question here, or can you ask it right away?
Okay, yeah, anyway, it's a quick question, okay. Hi, Venkat. Thanks for your time, and thanks, Mahendran, for giving us this opportunity. My question is, what is the typical percentage of equity could be provided for an advisory board member? I know you have spoke briefly about it. It is subjective, but still, based on the current market condition for technology product development company, what would be a typical ballpark to be provided for a advisory board member?
Sure. So I would look at determining value of advisory board member to you, right? Often we end up having these advisory board names more to carry credibility to in front of investors or customers. Instead, you have to convert them into active advisory board member. And if, for example, they are committing 3-4 hours in a month, or let's say 4 to 5 hours consulting to you, meaning time to you. Depending on what the value they bring, right? The value they can bring would be to advise you on the product engineering or design or whatever, right? That's number one. Number two, they can, any business strategy, sometimes you want to work with them. That's another area. Third area is you can ask them, open the door for me with the customer, or you can ask them to join you in a business discussion with the customer. Because when, instead of you going and explaining your product strength or product demo, if an advisory board member who was a former CIO of large companies with you, and he says, hey, look, to his buddy, he says, hey, John, look, I know Salman is a great technocrat, and this product is an outstanding product. That brings a lot more credibility to your product. When you see value delivered by them is high. It can be any of these situations. If it is a standard business strategy or engineering strategy and all that, at the beginning stage of your company, I would suggest you consider anything between 0.5% to 1%, depending on what's the valuation you have and all that. If, for example, you're thinking your value of your company is $10 million, I would think you give them 0.25%, not more than that. See, end of the day, the value of and for every completed year of their working with you, you need to give them something, right? Like for example, if they complete 1 year with you, you can give them 0.25% of your equity or options. So that way, you keep them happy. And also, it's a good practice once in 3 months or once in a month or so, you can have a call with them, bring them up to speed. Make them motivated, and this is the way to go. I don't know whether that helps, Salman.
Thank you very much, Venkat. It did.
Thank you for the question, Salman. We have yet another question from Jitendra. Which category these corporate ventures fall in? Example: Google venture, Microsoft venture.
So. Google Ventures, see now some of the Series A raise today, people are raising 25 million, 50 million in Series A. Some of the other people, a few years back it used to be about $1 million to 3 million, then it came to 5 and all that. Okay, so if you look at the valuations are going up very high. So Google Ventures and Microsoft Ventures, they typically invest in technologies that can further their existing, portfolio of assets, right? So I would consider them as investors in my Series A or Series B, right? Series A, for example, if I'm having a India team and also US firms, some of the Google venture investors in India are very comfortable investing in Series A in your Indian company, for example, right? Or some of them these days, I see them also investing in an American company from the Google Ventures India. The advantage being, that they are able to bring some of their portfolio companies and all that to your help. So I would put them, depending on the stage of your fundraising, they can be either a Series A investor or a Series B investor. Okay. Priya, other questions?
Yeah, there is one more from Moti. How in term sheet, how it works?
So so term sheet. For example, when we are in convertible note, typically you can have a one-page summary term sheet that will lay out 6% interest or 6% coupon rate, 24 months. Valuation cap of $4 million, all that laid out. That's one term sheet, right? It's a standard term sheet. Anybody subscribing to that particular convertible note issue, they need to agree to it, and your attorney will draft the subscription agreement and you will get it. Now, in the case of Series A, for example, the term sheet is usually negotiated by the lead investor actually. Okay, like for example, I'm raising $5 million, and the lead investor wants to subscribe $3 million or $200 million on that term sheet. So he will negotiate the term sheet with you, and the other investors would piggyback on that term sheet. So usually there are standard conditions available for term sheet, but again it is a question of negotiation between you, meaning the entrepreneur, and the investor. My suggestion is often it is better that you have a law firm which practices in the VC side of business supporting you. So when you are selecting a law firm, it's very important you have to look at few things. Don't go to any lawyer that practices on the corporate security side. As an entrepreneur, you need to interview him. Ask him, have you done any VC, type transaction advisory? Have you done? It's very important. Sometimes, you may end up working with a guy who is specializing on PE funds or other investors. Such guys will not be able to help you on the VC side. Because VCs and other investors like PE funds, they hate each other, right? VCs, they think they know the world, right? When they want to negotiate, your attorney should know how to negotiate with the VC. So along with term sheet conditions, you also need to protect your interest, right? As a founder of the company, if you would like to retain your control over the company, it's very important before you go and sign the binding or a non-binding term sheet, have a sitting with your attorney, understand whether the terms are favorable to you. If your terms are not favorable, counter them and then finalize the term sheet. Along with the term sheet, you must also have a clear subscription agreement, or for lack of a better word, an operating agreement with your other founders and also with your lead investor. These things should be absolutely be made very clear. If you don't have proper legal advice at this stage, what might happen is, you might end up, let's say, handing over 51% of your control of your company to a VC, and suddenly your competitor may come through the back door and buy your company, and you will suddenly find you have no more control of your company. So, you don't want that situation.
Okay, I have a very simple question. Are you able to hear me, please?
Yes.
All right, this is Velankani Raj. My question is regarding the angel investors. How do we identify them, please? Are there angel investors for different categories of investment, like say for computer products, for software, and for real estate and stuff like that? Or is there an association where all these angel investors are registered, so we just go there and get the list and go and approach them for help? So how do we identify the angel investors for a particular product or for a particular service?
So that's a very good question. Let me speak from my experience, right? I mostly work in biotechnology and technology. Those are the two sectors I work. Biotechnology has got its own set of investors, angel investors. Typically, these angel investors are guys who have made money, entrepreneurs who made money from a biotech company and things like that. In the case of, if you are in the biotechnology space, it would be more better to go to a angel investor group that is industry focused. In the case of technology companies also, I would suggest you go to an industry oriented angel investor group. Typically, these angel investor groups are state centric or city based. If you are in California or New York, for example, you can see plenty of angel groups. You can come across either city-based, they would say the state of New York angel group or New Jersey state angel group and all that. Sometimes, if you are a graduate or an alumni of a Ivy League school like Harvard or Wharton or Columbia, those angels also have their own angel groups or when VC funds. You can approach them. That is another, you reach out to your university alumni, and sometimes they may be able to put in touch with angels coming out of that group. But if you don't have any of these, credentials, the best would be to look at the state and the city where you live and see. It's always better to start from your local groups. And what you have to understand is you may not be successful in the first 1 or 2 or 3 rounds of conversations with people, because every time you are learning, right? And what you have to remember is these angel investors, before you speak to them, you have to ask certain qualifying questions like, have you invested in the past? What are the sectors you have invested? Typically, what is your check size? What do you look for? The reason I say you have to ask these questions is then you will understand what he is expecting, and then you make your pitch. I have made this mistake in my prior startups, right? Which is, when I see an angel investor who says, I'm a professional investor, I go and immediately I start making presentations without even qualifying whether he is interested in investing in that particular space. And then I will keep waiting endlessly, sending emails or phone calls or trying to meet him and all that. It's a pure waste of time. In the first meeting, make a 5 minutes or so elevator pitch, see whether he's interested. In that 5-minute 5-minute conversation, see whether he is interested or if he is willing to invest in your space. If he is willing to invest in your space, you can further continue to engage with him. Otherwise, don't waste your time. After you have met and interacted with your local angel groups, I would suggest start reaching out to your regional groups, and then mass mailing, I think probably it's not a successful process. One of the other ways I have seen angel investors are getting attracted is you're having an influencer as your investor, Vellankani Raj. Like, for example, if just for the sake of conversation, I'm saying this. For example, if Rajinikanth likes you and he writes a check to you, then suddenly you become a popular company, and everybody wants to invest in that company. That's one way to go. Or you find a very popular CIO from the industry writing a check to you, even if it is $25,000. When he has invested, and you say that to the angel investors, there is a herd mentality. People will immediately invest in your company. Those are some of the tricks I have seen people following.
Okay, thank you. Thank you so much.
Are there any more questions? Do you have any questions? No. Okay. So I think it's all. I think the question session is over, and the recording of this would be available, so you can access it anytime. Thank you, Venkat, very much. It was really nice. It's very interesting, first of all, and personally, I learned a lot. And I, of course, thank all the attendees for the wonderful questions and coming out with a lot of ways to make us think. And Mahendran for coordinating the whole thing. Thank you very much. You helped me a lot. So without you, this would have not been successful at all. And